Hello everyone and welcome to this class. In this class, we'll be talking about liquidity, concept of liquidity, okay? And this is lesson 8 of our SMC strategy series. And we'll talk about liquidity. This is very, very interesting topic, okay? When they say something is liquid in economics, I'm talking about science now. In science, it means that it's what you, but economics and financial institutions, it simply means how easily you can sell it or buy it, how easily you can transact that stuff. So if they say iPhone is liquid, that means it's easy to sell. If you own an iPhone now, you say you want to sell it, very, very easily you get a buyer. Okay. So it's a kind of a liquid commodity. Okay. So in by definition, we can say liquidity is the ability to buy or sell in the market without altering the price, okay? Without causing a significant alteration to the price. If you have there are some shit coins that if you buy as little as $1,000, you see the price will increase by 5% or 10%. That is not a liquid asset. The liquidity is very, very low in it. That is why you see the price reacting to that buying or selling. If the liquidity is not there at all, you'll not be able to buy it. That means nobody's interested in transacting. That thing is not liquid. It can't be converted to money, right? That is what it is. But if you see an asset that has a very good liquidity, sorry, that means you can easily sell it. You can easily buy it without changing the price. Okay, or else you are buying with a very big amount of money, or you are buying a very large volume. That's when it's going to affect the price. An example of a very liquid asset is Bitcoin. Bitcoin is the most liquid out of all the cryptocurrency we have, because you cannot carry even $1 million and buy Bitcoin and expect it to just change by 20%. No, it will never do that. Okay, it will never do that, because the market cap is in billion. You can't buy with 1 million and expect it to move up or move down. You understand? So that is just textbook definition. But in layman terms, liquidity simply means money. Okay? Liquidity simply means money. If they say somebody has been liquidated, that means he's out of money. He's no longer having money. If somebody is liquid, that means he has money. That's what it is in layman terms. Okay? Now, you have to remember that I told you some point in the beginning of this course that trading is a zero-sum game. Zero-sum game. All right. This simply means that for you to be able to buy, you need someone who is interested in selling. For you to be able to sell, you need someone who is interested in buying. Okay. So if you are buying an asset, let's say for example, €0 at any point, that means you're actually buying, you are picking a sell order of somebody. Okay. If I decide that I want to buy from here, I want to buy at this point now, which is 1.09384. Okay. This means that at this point, I will need somebody who is selling here. If nobody is selling at this point, I will not be able to buy. Okay. Yes. If nobody is selling here, I will not be able to buy. So for you to be able to buy anything, you need somebody who wants to sell it. And for you to be able to sell anything, you need somebody who wants to buy it. So this buying and selling orders that line all around the charts at every point. Some people will believe that this €0 is too expensive at this current point, 1.09885. So they want to buy it at a lower price. They will put their buy order here. Somebody will feel that, okay, I've been buying since I'm now in profit. I want to sell. Or I thought it's going to go from here and it just keep going down. I don't want to lose all my money. I want to sell it like that in loss. Okay. So anytime you are buying, you are buying, you are picking a sell order. Every time you are selling, you are picking a buy order. Okay. Now, there are two ways we use liquidity in SMC. Okay. There are two ways we use liquidity in SMC. And the first way is we need liquidity. Number one, we need liquidity to take. Okay. And we have liquidity to sweep. You can name these things anyhow you want to name it, okay? But when I explain it, you understand. I just decided to call it this way, okay? Some people will say liquidity to grab and liquidity to anyhow you want to name it, but I will explain it. Now, the first one is liquidity to take. This liquidity to take is what will help you exit the market. Like you're already in that trade, now you want to exit. That's liquidity to take. Then you need also liquidity to sweep. Or, okay, sorry, let me say liquidity to take is the one that will trigger you into, like, you want to buy, you need some buy orders. You want to buy at a point where there are buy orders, where you feel there will be buy orders. Okay, so I can say that's liquidity to take. Okay, then on the other hand, I can say I'm already in that trade. I've already bought at this point. Okay, I've already looked for a liquidity above this point, and I'm able to buy. All right, I'm able to buy. Now I still need liquidity to sell. I also need liquidity to sell. So I can call that liquidity to sweep. I just decided to call it this way. You can call it anything you want to call it. Just understand it, okay? You need liquidity to get into the trade. You also need liquidity to get out of the trade. Because everything you are doing, you need somebody on the other end to pick your order. If you are putting a buy order, you need somebody to have a corresponding sell order so that you're able to take that trade. And if you are putting a sell order, you need somebody that is taking a buy order. You understand? This market just works in a way that we sell to each other. All the forex traders, all the traders in the world, we are selling to each other, buying from each other. Okay. Now, I'm sorry to say this, but it is the reality. This world is not a fair place. Okay. Your aim is for you to make somebody buy at a point he doesn't want to buy, a point that is not favorable to him, and also make him sell at a point that is not favorable to him also. That's how this market is. When somebody is selling at a point that is not favorable to him, that means he's losing money. Now, the money is losing is going to the person that is buying it at that point. For example, I have a trade, a chart moving like this. Okay, just follow the chart. And somebody that doesn't know anything about market structure, just because he saw that price is moving up like this, he just press buy here. He just enter a buy order here. Okay, and immediately he enter a buy order. This is a high price have to reverse. So price begins to go against him. Is in loss. He begins to go against him. Is in loss. You understand? So at the end of the day, he might decide to just close his loss. Now, closing his loss means that he's selling what he bought at a higher price. He's not selling it at a lower price, incurring losses. So it's somebody that knows market structure that will place his buy around this place where he's already frustrated that I can't hold this again. That person is the one buying it now. So you are eventually buying something from somebody at a price that he doesn't like. So when price begins to appreciate, somebody else will see price moving down. And because he see price moving down, he can just decide to enter a sell. He enter a sell position, then he begins to go against him. At this level, he feel like I can't hold this trade again. I want to sell out. Like that, in loss. That means he bought it at sorry, he sold it at a lower price and bought it back at a higher price. So you need two type of liquidity. Liquidity that will put you into the trade and liquidity that will take you out of the trade. Those are the two liquidities you need, because you need liquidity to be able to buy or to be able to sell. All right. Now, you can visualize this liquidity as orders. As what? As orders. As orders that people placed. Okay? Orders. This is liquidity. When you see order, somebody is willing to buy at some point, that means it's putting his money at that point. So that money is liquidity. Okay. So we have different type of orders that we can use as liquidity. We have stop orders. Okay. And these stop orders include stop buy, stop sell, SA, that's stop loss, and take profits. All these are what are stop orders. I don't know if I'm supposed to start explaining this. These are elementary, but I'll just brief them. Okay. Now, stop buy is simply somebody buying at a higher price. Okay. The current price of Euro USD is 1.09884. So if you want to buy at this level, you want to buy at this point, which is higher than the current price. Okay. You want to buy at 1.09999. That means you are buying higher than this at the price. Maybe you believe that if price can move up and break out, there's something called breakout traders. If price can move up and break this high, then to continue going up. So you put your what? Your buy orders at the top, your stop buy orders at the top. Then we have stop sell. Stop sell is opposite of stop buy. Okay. You believe that if price should go below this points, for example, right? Price should go below this low here, then it's going to just keep going down, right? It's just going to keep going down. So you put your sell stop just below the low so that when the price get to that low, it will keep going down, right? And you'll be in your trade. Okay, so that's sell stop. Then the next one is stop loss. You are in a trade, just like what I have here. This is an example. My entry point is this 1.0939. Then my SL is 1.09222. It's also an order. Okay. If I get into this point, into this trade at this level, which is 1.090, I'm selling. So if I started selling from here, that means my SL is a buy. I want to buy back in, okay? But now in an unfavorable price, because I started selling at a lower price. The aim is to buy back at even a lower price so that I will make profits. It's just like buying something at a 10 naira, okay? But sorry, say something at $10. Sorry, excuse me, give me a moment, please. I need to attend to something. All right. We that stop loss now is what is also about is the order, because if you are selling, the next the opposite trade is going to be buy. So it's just like I bought something at $10, right? And I sold something at $10 and I want to buy it back at 5. Automatically I've made profit because I sold it at 10, I bought it back at 5. I've made $5 profit. But if I sold it at 10 and bought it back at 15, I made loss, right? That's exactly how it is. So if I'm selling at this point, 1.09039, I'm buying back at higher price, I made loss. That's how I call it a stop loss, but it's still a buy stop order, okay? But in form of a stop loss, right? So there are also, that means there are also order here at this top. I also have a pending order here, okay? Then if it is take profit, which is here, also it is also order because I'm now buying at a price. But this, if I bought back at this lower price, I will make profits. Now, these are the 4 things you are looking for. You will now be looking at the charts, thinking of where people will put their stop orders. This is what you need. You need these stop orders. Okay? You need these stop orders to fuel your entry and your exits. You don't want to enter a where there's no liquidity to just be stopped. So you want to enter where there's much liquidity and you want to exit where there's much liquidity. Okay? Now, for us to do this, we'll go back to retail strategy. Okay, we'll go back to retail strategy. Okay, that is where we'll be looking for the orders using retail strategy. For example, there's a strategy of retailers that we learned in this retail strategy, trading strategy, which is what? A double top. This double top, abi, top one, top two, okay? Then we break neckline, okay? So we expect that people that are trading, people that are trading from, people that are trading from retail strategy, we have their stop loss above here. We are interested in that stop loss. So we are looking for a way to put our own order just above their stop loss, like that, so that by the time price invalidates their stop loss, which is tap into our own entry, they are already out. Now, the money they are losing is what we'll be making when price start going down back. Okay, so one of the places you can find the orders is what? Double top and double bottoms. Double tops and double bottom. That's one. Then another one is we can also have a retail trader that will see something like this, right? And they will just draw a trend line and say, wow, this is a trend line. When price come back, I want to buy. Then my stop loss will be here. Something like that, right? Now we are looking for a way, or let me say the stop loss will be just slightly below the trend line, somewhere like this. So we are now looking for a way such that we'll put our entry, our buy entry just below that, so that when price move ahead and activate trigger a stop loss, is forced to sell at a price it doesn't like. That's one of our concern. Our own is that we are the one buying it as he's selling it. He's already lost his money, but that will be what will give us profits. So this kind of liquidity is called trend lines liquidity. Somebody's already giving me a expo in the comments. Please let's calm down so that this thing will be interesting. Trend lines liquidity. Okay. These are very, very interesting things. Okay. Trend lines liquidity. This is not all. We still have more. Okay. We still have more. Now let's look at another one. I'm just looking for a clean place. Okay. Now let's say we have something like this. Price moving in uptrend like that. Okay. Now somebody may decide to put his entry here, just put like a buy stop here, so that when price break this high, he believes that that's when price will start going up. Okay, can put his entry here, his entry for a buy at this point. Okay, so we really want to buy that order for him, so we will look for a way to put our entry just above that side, such that by the time his entry triggers, it will just start going against him immediately. What's going on? Oh, this is not good. I think I've over zoom. Sorry. Where? Okay. Trading view can be very, very frustrating sometimes. Okay. All right. So we want to have our entry just above that side, so that immediately order activates, it will activate into our short order and price will begin to go against him. Okay. Like that. That's also a form of liquidity. I think we'll call that BSA. You can just call it BOS, like break of structure liquidity. Just take it that way. Okay. I don't want to cause confusion. Let's just take that break of structure liquidity, right? Because break of structure is also liquidity. That's why you see it move up. Some people's buy stops are there. That's why I move up. Okay. Then we have the last one. We have the last one that we'll talk about for now. Not last one. We have second to the last one. And we know that very, very well. There are also liquidity here because people keep entering and putting their stop loss below here. People that are trading with trends. Okay, as what we have explained earlier, when you enter at this zone of demand. So definitely you know that there are some liquidity below. There are a lot of people putting their stop loss below these points, stop loss below here, stop loss below here. So all those points, there are liquidity there. And that's what we call BSL now. Or is it SSL? Sorry, I mixed them together. I think it's BSL, buy side liquidity, BSL. Then we have the opposite of it, which is SSL, sell side liquidity. Okay. Now that's when we are in a downtrend. When we are in a downtrend like this, there's SL here, there's SL here. So those SL are also stop bending orders and they are form of what? Form of liquidity. Okay. So these are liquidities you want to use to fill your entry, either to get into a trade or to get out of the trade. Those are the two things you use liquidity for, to get into that trade or to get out of that trade. Okay, that's two things you need the liquidity for. All right, we are moving forward. I have to clear all this because I'm already getting lost. And just clear everything. Okay. Now we'll look for how to see these things on the chart. Okay. Now we'll start from equal highs, equal lows, equal highs, equal lows. Don't be confused. Equal highs are the same thing as double top, and equal lows are the same thing as double bottom. Okay. Then trend line. These are the ones we'll talk about for now. Okay. These are the ones we'll talk about for now. Now let's assume we have a price moving upwards like this. Okay. Now we know that we want to trade inside here. This is where our demand zone is. That's where we want to trade from. Okay. That's where we want to trade from. Now, price will come back down on a lower time frame using internal liquidity to also come back down this way, right? Now, is this structure now that we want to see something like equal low, something like this? Okay, this internal structure now, I want to see something like equal lows that is very close to an order block. Let's say there's an order block here. And there's equal low here, just right here, this equal low. So this is a liquidity to take. We are just looking for how to use this liquidity now to get into the trade. So we will now place our entry on that order block below, just below the liquidity. Okay, just below it. Okay, so that by the time we know that somebody will want to see this as a double bottom, break of neckline, and put his entry here at the break of the neckline, put his stop loss below this double bottom. So it's that stop loss we want to use to foil our entry. Okay, so we are expecting price to come and rip his stop loss and tap into our back so that price can freely move up. This kind of low score, we can just name it equal low, EQA. Okay, now we use this to enter our trade. Now we need something to exit. We also need liquidity, and that's why we'll go for this BUS liquidity up here. We know that price will come. There's still other people putting their entry above here for buy for breakout buyers, okay? People that buy breakouts. So they are the one who want to sell what we bought here too. And that's where our SL will be. Okay. Remember, you need the break of structure first. Seems like this. All right. So this is how you apply equal lows. You just switch it over for what? For equal highs. Let's do that. For sale now, let's say we have price going down. Let's say we have price going down, and the broke structure right here. Okay. The broke structure right here. Now, you know that when it's beginning to go down, it will also be going in series of lower low, lower high. That's how it will be going, right? So you now create something like this at some points. So this is equal highs now, okay? This gives equal highs now, something like this, equal highs. And we have an order block just below, just above it. So we already know that there are some people that will put their stop loss below this double bottom. Sorry, double top, which is equal highs. All right, so that's what we need to fuel our entry for our order block. This thing just started misbehaving today. I don't know why I started this bullshit. So we want to use it to enter into the trade. That's liquidity to take. You can name it any. I don't let liquidity to take or liquidity to grab confuse you. The name is very not important. Just understand the concept, okay? So you want to tap it and price begins to go up. And price begins to go up. Where are we targeting? We are targeting people that have their sales stop here. So that's what we'll be targeting for our entry, our take profits. Is this clear? I think it is. So this is the only one we'll take today. Time is against us. We would have gone, okay, we'll try and look for one example, okay? But I remember one more type of liquidity, and that is fake order blocks. We'll explain it in the next class. Fake order blocks, okay? Fake order blocks. And also we can have fake change of character, but let me just include it. Fake change of character. We'll elaborate on them on the next class, okay? So let's just work with what we have explained now. Let's look for this on the group chat. On the chat, let's look for this kind of setup. I hope we see one. If we cannot see one, then I'll just look for it. And that's where we'll start our next class, okay? Let's hope we'll see one. Let's look for one, okay? So that you see what it actually looks like, okay? This thing always waste time to find it in real time like this. Because you don't expect to find it easily, because that's where the money is. Making money cannot be easy like that at first. It only gets easy as you do it often and often. Did I just see one? Oh, already. Come on now, what is causing me delay? Come on. This is an example right here. We have price break structure below. Okay. Then we have this kind of equal high serving as liquidity. There are others here, stop losses and all just above this equal high. Price clear into it, tap into this other block. Okay, then just sell. That's an example. Okay. All right, I will look for more examples. Okay, and we'll start from there from the next class. Okay, so we'll be going into other stuffs. Trend line liquidity, buy side liquidity, sell side liquidity, big order blocks. That's what we're doing in the next class. So this is your work to do for this class. Open your charts and look for equal lows, equal highs, and price taking it, tapping into no other block and moving upward as much as you can. I'll be very glad if you all can find these kind of things and share them with us on the group chat, okay? So that we can all see it together, right? So that will be all for this particular example. For this particular topic, or let me say for this class. All right, we'll continue from here in the next class. Thank you for your time and see you on the next one.